Right, hi guys, welcome to my live stream. My name is Zahir Anwari. I'm a co-founder here at Sublime Trading. We specialize in helping CEOs and high salary earners get consistent returns in the stock market using a proven strategy and in only 30 to 60 minutes a week. And for those of you here in the UK, we also show you how to do that tax-free. Okay, so let's get straight into today's live stream. I'm going to be looking at the tech sector. There's a lot of talk on social media right now on the tech sector. Obviously, it's taken a massive hit this year. Not all stocks. There are still some stocks in the tech sector that are holding fairly well. Some of these stocks you probably may not have heard of, or certainly not on your radar. But the more common stocks, Tesla, Microsoft, Apple, all of those sort of stocks, they've taken a significant hit. So we're going to look into those stocks, look at what the future lies in terms of whether we will see continued weakness or whether there would be a revival of some sort, or maybe even just tech stocks just going nowhere, sideways for the foreseeable future. And if tech stocks are really where you want to be focusing on right now, and instead, I'll be sharing some of the better looking stocks on my watch list. Some of these are from other sectors. In fact, they're all from other sectors: consumer discretionary, financials, industrials. There's a lot of sectors out there that ultimately the goal of these guys is to always find the strongest stocks in the strongest sectors. As investors, the goal is to make profit. The goal isn't to be right. If you're focusing on Tesla all the time, then there's an element of ego being involved there and an element of just having to prove that, yes, you are right about what Tesla is going to do next. That isn't the case. That's not going to get you very far. The goal is to always focus on profit and not to be right. And so to focus on profit, we always want to make sure that we're focusing on the right stocks at the right time and then using the right strategy to extract profit. Okay, so let's get into the stocks on our list. So I'll start with Apple. This is a typical three-screen setup that I use whenever I do my analysis. I've got the monthly in the top left, weekly in the top right, and the daily chart across the bottom. I look at the bigger picture because I'm a trend follower, and so I'm looking for the big moves and really to do as little as possible to make as much money as possible. That's really the goal. Day trading doesn't really get you there. A lot of screen time and a lot of inconsistency involved. Good days, bad days, just cancels each other out. So trend following, looking at long-term trends, that's really where you want to be focusing on and looking to invest in. Okay, let's start with the monthly time frame. So Apple in itself, it's got a fairly decent history of performance. We know that since around 2006, it's gone from a few dollars, $2, $3 to the high of January, which was just over $180. So a significant move. However, if you look at the history of Apple, it's not the smoothest. You have a move, then you have a deep correction, another move, another deep correction, consolidation, another move, another deep correction, and then this sort of fairly bumpy run to its current all-time high. Created the current all-time high at the start of this year in January, and since then it's been in this decline. It's now trading around just under $130. If you look at the decline itself, it's not the worst decline compared to, say, PayPal. 30% is pretty significant. But if you look at PayPal and Tesla, they both dropped around 70, 80%. So Apple has held fairly well. However, if you look at the month of December, a significant move to the downside. And so what we could potentially be seeing is further weakness towards this red line, which is the lowest point of last year. When price remains within the annual levels of last year, so this green is the high of last year, this is the low of last year, what you have is more of a sort of sideways market. It could be sideways to up or sideways to down. This is sideways to down. If it breaks below the low of last year, then we're starting to enter bearish territory. Let's move across to the weekly time frame. Now, in the weekly time frame, we have the 200 moving average, which is the black line. We've got the 50 simple moving average, which is the orange line. And if you notice, we've got green bars, gray bars, and red bars. So that's a trend filter that we've developed that identifies bullish periods, bearish periods, and then standard side periods. And this is what I mean by Apple currently being sideways to down. You can see that the trend filter, there's green, gray, and red. When you have green, gray, and red, that's very much a sideways market. You can see that with the way the price has moved. It's more of a sideways market. But if you look at what's happened in recent weeks, we've seen this lowest point of the consolidation, which is from June, that's now been broken. And what that means is price could work its way towards the 200 simple moving average. If that is broken, then we're entering bearish territory. And it's really important to understand that. If I compress the chart, you can see how the 200 simple moving average on Apple has been used as support going all the way back to 2008. You can see that here, broke just a little bit below it, bounced off it, came back to the 200 moving average in 2013, bounced off it, came back again in 2016, bounced off it, came back in 2019, has remained above the 200 simple moving average. So where is price going now? Well, it's likely to move back towards that 200 moving average just because that's what it does in terms of its natural movement. And when it comes to this level, that's where we then have to figure out whether we want to start buying into this stock at some point in the future. That's if there's a bounce to the upside and price remains above the 200 moving average, we could potentially start buying in. Or if it breaks through it and that $100 round number, then we could start seeing further weakness. If you look on the daily time frame, well, on the daily time frame, price is already below the 200 moving average. It's below the 50 and it's below the 20 simple moving average. This blue line is the 20 simple moving average, which I also have on the daily time frame. And we can see that price is really starting to weaken. If you look at pre-market, there is a bit of a gap up. So now it remains to be seen whether we get some kind of reversal candle or whether it's a gap up and then continuation. We're really in this sort of territory where we have no idea what the tech sector wants to do. And so the safest option really is to stand aside. Okay, let's have a look at Microsoft. Now, Microsoft is one of those stocks that has an absolutely brilliant performance history. You can see how smooth this particular stock is. Looking at the monthly time frame, if you look at it from this area here, which is 2016, when it was trading around $50, created a high of around $350 and has been correcting since then. So again, after such a good move like this, there's bound to be a correction. And that's what people tend to sort of overlook. And then they get caught up in the news on social media saying that we're in a bear market, the world is coming to an end and all of that kind of stuff. We really want to get away from that, look at the market in a more sort of objective way. And the way to do that is by looking at the charts. All we're seeing for now is a correction. Also notice that it hasn't broken below the lowest point of last year. Same as if you just go back to Apple. Apple hasn't broken the lowest point of last year. So we haven't really entered bearish territory on Microsoft either. If you look at the weekly, it's now bouncing off the 200 simple moving average. We had a bounce off it, came to the 50, had a bounce to the downside. So it now remains to be seen whether we get weakness and price breaks through the 200 moving average and that $200 round number, or this area holds strong as support and we get a bounce to the upside. There's no guessing right now, and whichever direction you may choose to jump into, it's just purely guesswork until we actually get that direction. On the daily, rather, you can see that price is below the 200 moving average. We've got weakness below the 50 and the 20 simple moving averages. The trend filter is also red. So what we have is a mixture of bullish and bearish factors. So for me, not really a clear direction for now, and why also you want to be standing aside on Microsoft. Oh, okay. Give me 1 second. I realize that I have made a mistake here. Thanks for the update there, Murray. I recognize that username. All right, just give me 1 second. All right, here we go. Okay, if you can just give me a thumbs up that you can see Microsoft. Apologies for that. And because I was sharing the wrong screen. Apologies, amateur mistake. Yeah, brilliant. I'll quickly go through Apple just once again so you guys can see what I mean. We've got the highest point of last year, the lowest point of last year. Apple is still trading inside the high and the low of last year. If we go to the weekly, I mentioned that the 200 simple moving average on Apple on the weekly has been used as support numerous times, going all the way back to even further than that. If you go back to 2008, you can see how it's never broken below the 200 moving average on the weekly. So we are seeing weakness. Whether it falls below, yeah, Microsoft is on the same screen. What's going on today? Bear with me. Yeah, we're looking at Apple. So you should be able to see my Apple chart now, and then I'll switch over to Microsoft in a second. So I'm looking at Apple. Seems to be working fine from what I can see. Yep, seems to be working fine. Okay, and then on the daily, price is already below the 200 moving average. The trend filter is red. So Apple, mixture of bullish and bearish factors. If I move across to Microsoft, yep, and you should be able to see Microsoft now. So I think that's working fine. Microsoft also between, if we look at a monthly time frame, between the high and the low of last year on the monthly time frame, really good looking stock. So bound to be some kind of correction, which is what we're seeing. On the weekly, it's at the 200 moving average. So if it breaks below the 200 moving average, then we're likely to see further weakness, particularly if it breaks below $200. If it holds stronger support and we see strength to the upside, then we could see price work its way back to the current all-time high. For now, we're in that sort of no man's land where we have no real clarity on which direction the market wants to go. On the daily, we can see that price is below the 200 moving average. And if you look at what's happening on the daily, the 200 moving average is being used as resistance and it's forcing price down. So we're in this very interesting space where the 200 moving average on the weekly is acting as support. And as its big brother, I'm likely to side with the larger time frame, with the higher time frame. So my bias is more of a bounce to the upside. But of course, that's not a guarantee. The 200 moving average on the daily could hold strong as resistance, and it is, you can see, forcing price down. So if it closes below the lowest point of November, then we could see further weakness to the downside. At this point, I'm more inclined to just stand aside because they are better looking stocks. Remember, this is just the tech sector. The stock market is made up of a number of sectors. So as an investor, what you want to be doing is looking at the best stocks in the best sectors. Tech had its run post-corona. So sort of early to mid 2020 through to the end of 2021. That's when the tech sector was booming. The money has now left the tech sector. Doesn't mean that it's disappeared altogether and people are sitting in cash. It means potentially that the money has flowed to another sector. And that's what we're going to be looking at once I've gone through the rest of these tech stocks. Okay, Nvidia. Nvidia is a top performer of ours numerous times over the years. You can see this run from when it broke through the highest point here at around $10. This has gone through a stock split recently, hence why it looks cheaper than it was once upon a time. But you can see there was a good run from around $10 to $70. Then there was a correction. Then we had another fantastic run from that $70 all the way to $350. Again, because there was such a big run, there's bound to be a correction. And if you look at that correction, again, it's trading between the high and the low of last year. It hasn't broken through the lowest point of last year. And if we go to the weekly, we can see how it's using the 200 simple moving average as a support zone. Now we want to see whether we get a bounce off it or whether the lowest point of October is broken and we get further weakness, particularly below that $100 round number. And if we go back to the daily, we're seeing something similar in that the 200 moving average on the daily is currently a resistance zone and we're seeing weakness to the downside. So we've got support on the weekly, we've got resistance on the daily. Which one is going to win? We have no idea. So the best option is to let the market dictate. Okay, so that's Nvidia. Let's move on to PayPal. Yep, you can see PayPal. So PayPal has taken a real tanking. It has a fairly good history up until the highest point of last year, July 2021. And since then, it has fallen around 80% from the high of $310 to roughly $67, $68 now. Now, if you look at the weekly, below the 200 moving average, and if you go to the daily, also below the 200 moving average. But if you look at it from, let's say, March, it's really just kind of been going sideways. You had a bit of a drop here, but it's really been going sideways. And again, this is a classic example of what is known as catching a falling knife. And what I mean by that is every time you think that, if you take this situation here, when the market starts dropping and you think, right, PayPal is cheap, I'm going to buy and it's going to reverse. And what tends to happen is that it keeps on dropping. And then the bigger mistake that people make is they buy more. So they buy more here, they buy more here, and all they end up doing is just blowing an account based on buying a stock that is dropping, thinking it's going to reverse. It's a mistake. That is what is known as catching a falling knife. What you want to do is wait for the market to dictate a direction and then buy the strongest stocks in that direction. Okay, so if you look at the weekly, as already mentioned, it's below the 200 moving average. It's below the 200 moving average on the daily. Now, why the 200 moving average? Because the 200 moving average is a proven indicator of the long-term trend. Old school traders used to draw charts by hand, so they were very particular with the information they put on their charts. The 200 moving average was a proven indicator of the long-term trend. So if price was above the 200 moving averages, they'd go long. If price was below the 200 moving averages, they'd go short. So the fact that PayPal is below the 200 moving average on the weekly and the daily suggests that, if anything, you should be shorting this stock. You shouldn't be buying this stock. And again, that's a mistake that a lot of people make. Okay, it's known as catching a falling knife. It's when you buy a stock that just keeps on dropping. I'm just going to catch up with some of these some of these messages. Lovely, thanks for the coins. Appreciate it. What do I do? Do I have to accept these coins? I have no idea. Thank you very much for the coins and appreciate your love for my hat. It's a British hat maker called Walter Wright. They go back to, I think, maybe the 18th century. They're a classic British hat maker. So if you're into hats, do some research. Walter Wright. Wright, Walter Wright. Okay, let's move on. Enough on my hat. Next stock, of course, Tesla. I mean, Tesla is definitely not a stock you want to be buying right now. Tesla had its run. Of course, it had its run, just like all tech stocks. December 2019 is when he broke out of this. If we just go back, broke out of this consolidation, which was in December of 2019. Went on this massive run that obviously got a lot of people excited. But what goes up must come down. And this has taken a real tanking. And we're looking at a decline of just over 70% now. Again, if you look at it from an objective point of view, it's trading below the lowest point of last year. Stocks that are trading below the lowest point of last year generally keep on dropping. Not always, but generally. So if you bought a load of stocks that were trading below the lowest point of last year, most of those stocks will continue dropping against you. Hi, Dark HD. Lovely to have you with us from Sri Lanka. I'm based here in London, UK. So thanks for coming in on the stream. If you've got any questions, guys, if you've got any other assets, stocks, commodities, currencies you want me to look at, please put them in the chat box and I'll do them at the end of this stream. Okay, again, look at where price is in relation to the weekly 200 moving average. It's below the weekly 200 moving average. So if anything, you want to be thinking about shorting it. I wouldn't be shorting it because the overall market is not bearish. The overall market is partly bullish, partly bearish. It could go either way at this point. So if you start shorting the market and the market starts going up, you leave yourself open to fake breakouts and losing money. So at this point, I'm just applying a little bit of patience. But Tesla is below the 200 moving average. And the daily time frame is also below the 200 moving average. So Tesla just keeps on dropping. Is it a stock you want to be buying now? Certainly not one that I would recommend. And I'll explain why when we go through the stocks that are on my watch list. Okay, let's start with ACGL, Arch Capital Group. If I'm correct, this is in the consumer discretionary sector. I believe it is. So let's have a look at Arch Capital Group. First of all, look at its history of performance, guys. Really, really good history of performance. This is one of the first things that you want to look at when investing in a stock. Open up the monthly time frame and look at how well it's performed in the past. If a stock has performed well in the past, then it's very likely to perform well in the future. I mean, if you look at something like Twitter, of course, Twitter has got a lot of attention in recent actually, I think it's been delisted. Where are we? Twitter? Yeah, it's not coming up anymore. Okay, that's fine. I mean, if you look at the history of Twitter, when it was when we can bring up the chart, it had a very jerky history. just a really large sideways range, and people were buying into that. And so what you were getting caught up in was just a market that was going sideways. We don't want that. What we want is a stock that has a good history of performance and that is now setting up to repeat that performance. So what do I look for? I look for a good history of performance on the monthly time frame. I look for a market that's consolidating. And then I look for a breakout from that consolidation. If I get that, that's a stock that has a very real potential of making it into my portfolio. Trend, consolidation, and then the next trend. And if we can get in early on these trends, then that is easy profit, because all I need to do is enter, hold my position. ACGL looking very, very good. On the weekly, guys, look at it. Above the 200, above the 50, the trend filter is green. And if we go to the daily, above the 200, above the 50, above the 20, the trend filter is green. We even had a gap up, and that gap up, if I'm correct, was due to earnings. My earnings labels have disappeared, but I think this was due to earnings. So you can see what can happen as well when we get a good earnings release. There can be a gap up, and then what is known as gap and go when the market really starts shooting in your favor. So ACGL, why would you want to be in Tesla or Apple or Microsoft or any of these stocks when you could be having ACGL in your portfolio? Okay, another stock, DE, Deere and Co. I believe this is in industrials. This stock is actually still in my portfolio. I've been holding this stock since August of 2020. Really good performance since then. Went through a consolidation, and if you look at what's happening, we could potentially start seeing price break out of consolidation and start pushing further up. On the weekly, price above the 200 moving average, the 50 simple moving average, the trend filter is green. And on the daily, price is above the 200, the 50 simple moving averages, bit of a consolidation. And that's expected, guys. And the reason why that is expected is because it's currently being faced with the previous all-time high from April this year. This is being held as resistance. And so when price gets to these sort of all-time highs, there's generally a battle between the bulls and the bears before the bulls kick in and continue. I mean, if we go back up to ACGL, and if we look at ACGL from a sort of objective point of view, you can see that, look, this point here was the previous level that forced price down. Market came through, and because of that gap up, it worked its way through it. But because if there wasn't a gap up, we could quite easily have seen a consolidation or further weakness before a continuation. So always be patient when a stock, let's go back to Deere and Co. Always be patient. If we look at the monthly time frame, we can see that November was a strong month for the bulls. December has been more of a bearish month, although nothing to be of concern given the fact that we've been heading up. All we're seeing is price at the current all-time high or resistance level. There's a bit of a battle, and then the bulls will come in and start pushing price up. So it's just an element of patience needed at this point. Okay, Coca-Cola. Not the best stock in terms of its performance history. I mean, yes, it's worked its way up. And if you've been investing in this and you're a Warren Buffett kind of hold forever kind of guy, then you've been rewarded. But in terms of its performance, you can see it's very bumpy, very jerky. It's not the smoothest of trends. And I don't hold stocks forever. Typically, I hold for 12 to 24 months because that's how long a trend lasts. That's when money leaves one sector, goes to another sector. So 12 to 24 months is typically how long I hold for before I rebalance the portfolio. And instead of Coca-Cola, I would rather look at DE or ACGL because they have much better history of performance. Having said that, it's always worth keeping an eye out on Coca-Cola because its performance can change. And if we go back to this area here, you can see this is a much cleaner looking trend. This is from 89 all the way through to 98. So you're looking at a 9-10 year run. That's what we want. A nice, clean looking trend. In recent years, it's been very bumpy. You can see that for yourself. Look at the pullbacks, look at the swings. That was Corona, although like most stocks, it recovered from Corona. But if it starts repeating this history, then that will be a stock that I will certainly look to have in the portfolio. But of course, I want it to set up. So what do I want it to do? I want it to break above the current all-time high. I want the trend filter to remain green, and that's when I'll start buying into Coca-Cola. If we look at the daily, above the 200 moving average, but just a sideways market for now. I'm waiting for the highest point of April to be broken. Once that's broken, and if you look at this trend, guys, it's actually quite a nice, clean trend emerging. It's holding above the 20 simple moving average. If we can see that going forward above the all-time high, then that's a stock that I will consider. Okay, another stock you guys will be familiar with, McDonald's. Consumer discretionary, of course. Good history of performance. Can pull back a little bit, but not too bad overall. Now, if you look at what's happening, as mentioned earlier, is that battle that happens between the Bulls and the Bears at the all-time high. Usually there's some kind of short-term weakness before a continuation of the long-term trend. So that's what we're seeing here on the weekly. Price above the 200 moving average and the 50 simple moving average. You can see this sort of short-term weakness. And also on the daily, price above the 200 moving average. Bit of a sideways market for now in a bigger sort of consolidation. So patience needed here. So what we're looking for is a breakout and a continuation of the bullish trend. But McDonald's very much on my watch list. I'm just waiting for that right setup. And as I mentioned earlier, because we're in this territory where the market is partly bullish, partly bearish, no real direction, we're going to see these sort of short-term swings until the market settles down. Okay, and we are now back to Apple. So that's my analysis. Just a reminder, Apple is a no, Microsoft is definitely a no, Nvidia is a no, PayPal is a no, and Tesla is a no. So all the sort of tech stocks that I'm looking at, just not, or tech stocks rather, that are in the tech sector that everyone seems to be talking about, they're all no's for me. ACGL, definitely one to watch. DE, one to watch. Coca-Cola, one to watch. McDonald's, one to watch. Okay, let's just have a look at a stock that is in the tech sector that is holding very well compared to a lot of the other stocks. Is CDNS. CDNS, we've invested in it numerous times over the years. Really good looking stock. Currently just stuck in a sideways market. If it breaks out above the high, then we will look to get back in. If you look at it in terms of the weekly, holding quite well above the weekly 200 moving average. This is what I mean by just a sideways market for now. If it breaks through the low of the consolidation, then we could see weakness back towards the 200 moving average. But for now, it's holding within that consolidation. And if you look at the daily, look how flat the moving averages are. The 200 moving average is flat. The 50 and the 20 are just sort of whipsawing above the 200 moving average. Price itself is just whipsawing sideways. It's just a sideways market for now. It's not one that you want to get involved in. What you do want to get involved in are trends. And if a market can dictate a nice clean trend to the upside, as opposed to this sort of whipsaw movement to this in a sideways market, that's what you want to be getting into. Okay, I can't see any questions coming through. Once again, I hope I've said your name correctly. Akolesnikov. I think you sound Russian, my friend. Thanks for the coins. Thanks for the compliments on the hat. Thanks, Dark HD, for coming in from Sri Lanka. Murray, if you want to drop me a message, Murray and Rothbard, I know that username. I'm pretty sure I know that username. So drop me a direct message to say hello. All right, guys. Look, that's the stream for today. This has been recorded. So if you want to go back in and review it, feel free to do that. If you want to reach out to us, you can direct message us. And I usually check the direct messages. So I will get back to you. And it's also being streamed on YouTube. So if you prefer to watch it on YouTube, then by all means do that as well. All right, guys, have a lovely rest of the day. There will be, looks like someone has just come in with a question. You just caught me in time. Right, could you please have a look at Sense? Okay, let's have a quick look at Sense. Sense X. Okay, we're looking at an Indian stock. Yeah? All right. Well, if I'm looking at the right chart, then it's looking fairly interesting. So the Nifty, I mean, let's start with the Nifty, okay? The Nifty is looking fairly interesting. I mean, if you compare it to the SPX, the S&P 500, the S&P 500 obviously is still recovering. Whereas the Nifty is very much leading the way. And so when an index is printing new highs or looking to print new highs, that's a really strong bull market. So with the Nifty looking to break out, I mean, it tried breaking out. It did break out actually in November. December has been a bearish month, again, as expected, because when you get to these levels of all-time highs, these sort of resistance levels, expect a battle between the bulls and the bears before a continuation. So that's what we've been seeing. If you go to the weekly, you can see the resistance already marked, short-term weakness. But if you look at this week's bullish so far. And if you go to the daily, you can see the weakness, but we are now starting to see a revival. So how is the year going to end? How is the year going to start? Remains to be seen. But as the overall market is bullish, we expect a continuation to the upside. We need to let the market dictate that. But there's a strong sign when stocks are breaking out and leading the way, then that's also a sign that the market is recovering. So let's take CG Power. I'll come to Sensex in a second. Look at CG Power. CG Power is an Indian stock. I mean, look, it's completely outperforming the index. So when there are stocks that are still bullish, it's a strong sign that the market is recovering and that we're likely to see a breakout and a strong 2023. We don't want to predict it. We want to let the market dictate it, but the signs are there that we are in this potential bull recovery and a bull market. And if India's leading the way in this case, who knows? America, US stocks, UK stocks may follow. Usually it's the US market, right? There's this expression that when America sneezes, everyone catches a cold, everyone else catches a cold. Times are changing. Who knows? So Sensex, look, very, very similar to the Nifty. Overall, looking strong. Currently just trading below the highest point of last year. On the weekly, same sort of setup, bit of weakness because it came to resistance, and also on the daily. So it's completely mirroring the Nifty. So I don't know what index this is. S&P. I mean, this is new to me, so thanks for sharing it. But the point is this, that it's mirroring the Nifty, and if it breaks out, then we're likely to see a continuation. Okay. Any further questions? If there aren't any other further questions, guys, I will end the stream here. I know there's a slight delay, so I'll just give it a minute or two. Okay, brilliant. No worries. You're welcome. All right. Okay. Well, look, guys, let's end the stream here. As I said, any further questions, do reach out to me and I will happily answer them for you. Have a lovely day, guys. And if we don't speak before New Year, wishing you all a very, very happy New Year and see you in 2023. Take care, guys. Cheers. Bye.